Hello traders, and welcome back to my channel. Spotting a valid pullback is one of the most important and challenging parts of market structure analysis. Every trader faces it at some point. Learning how to identify proper pullbacks helps you recognize real order blocks and inducement zones, and avoid getting caught in market traps. In today's advanced episode, we'll break down different types of pullbacks, trading strategies, and price actions you'll often see in the market. But that's not all. We'll also go over the key rules and conditions that turn a pullback into a high-probability trade setup. So traders, if that sounds interesting, please give this video a thumbs up to support the channel, and don't forget to subscribe if you're new here. See you right after the intro. Welcome back traders, so let's jump right in. The first step in understanding market structure is being able to spot a valid pullback. Without that skill, you won't be able to correctly read what the market wants to do next, whether a trend is continuing, a structure is breaking, or a reversal is forming. So what exactly is a pullback? A pullback is simply a temporary move against the main trend, a short pause or reversal as buyers and sellers battle for control. This reaction creates internal liquidity, areas of inefficiency or resting liquidity that the market needs to fill. Because of that, price briefly moves in the opposite direction to clean up that liquidity before continuing its main trend. Every price movement has three parts: the impulse, the correction, and the continuation. For example, if we treat a certain correction as a valid pullback, then we also confirm a break of structure. That lets us mark an order block at the bottom of the move. From there, we wait for price to return to that order block and then push upward again. To trade this, we can place a buy limit order at the top of that order block. But if the pullback we selected turns out to be invalid, even though it looked impulsive, then the order block we marked becomes invalid as well. In that case, price is very likely to break through the zone and hit our stop loss. Now let's go over how to identify a valid pullback and the rules we need to follow. Make sure you stick around until the end, because later we'll look at different pullback types, key price actions, and the strategies you can apply when trading them. Before we jump into candlestick examples, let's quickly review how candlestick uptrends and downtrends behave. In an uptrend, price forms a series of bullish candles where each candle makes a higher high, showing strong upward momentum. At the same time, each candle's low should stay equal to or higher than the previous one, showing that bearish pressure is limited and buyers are in control. The same logic applies in a downtrend, but in reverse. A candlestick downtrend is formed when price prints consecutive bearish candles, each one making a lower low, showing strong downward momentum. For the move to stay impulsive, each candle's high should remain equal to or lower than the previous high. Now let's apply this to identifying valid pullbacks. In a bullish trend, a pullback becomes valid when a candle breaks below the low of the previous candle or sweeps its liquidity. For example, if a red candle drops below the low of the earlier green candle, that confirms a valid pullback. If price does not break that previous low, the pullback is not valid. Also remember, candle color doesn't matter. Only the high and low points do. In a bearish trend, a pullback becomes valid when a candle breaks above the previous candle's high and sweeps liquidity. Let's reinforce this with an example. Imagine a clean bullish move made up of three strong green candles. Then the market pauses and prints three bearish candles before pushing back up. For this pause to count as a valid pullback, one of those bearish candles must break the low of the final bullish candle before the pause. If none of them break that low, then the entire move is still considered one bullish impulsive leg, not a pullback. In another example, after a run of bullish candles, the market prints a single bearish candle as a small pause. But because this candle does not break the low of any previous candle, it still does not count as a valid pullback. However, if that bearish candle forms an equal high with the previous bullish candle, and then the next candle breaks below the bearish candle's low, that does qualify as a valid pullback. In that case, we have a bullish impulse, a valid correction, a bullish continuation. These rules apply the same way in bearish markets and across all time frames. Here, we're looking at the Eurist 1-hour time frame, and price is clearly in a strong downtrend. Let's walk through how to identify the valid pullbacks within this structure. We first see 3 bearish candles, followed by a temporary pause of 3 smaller bullish candles. When we mark out the high and low of the last bearish candle before the pause, notice that none of the bullish candles break above its high, meaning this is not a valid pullback, but simply an impulse continuation. For a pullback to be valid, price needs to break or sweep the high of the last candle before the pause. A little further on the chart, price breaks that high, giving us our first valid pullback. We see the same thing again. Price breaks the high of the candle before the next pause, another valid pullback. The third valid pullback forms when a bullish engulfing candle breaks the previous candle's high, confirming structure. Now that we've understood the basic logic behind valid pullbacks, we can move into the advanced section, where we explore pullback types and how to trade them effectively. Pullbacks generally fall into 3 models: aggressive, corrective, and sweeping. Let's start with the aggressive pullback. An aggressive pullback happens when price makes a fast, sharp retracement against the trend, usually with big, strong candles moving quickly. In our example setup, price breaks below the previous candle's low, giving us a valid pullback. After completing the retracement, price shifts momentum strongly and creates a bullish break of structure, which allows us to mark a demand zone tied to that BOS. From here, we wait for price to return to that demand. But in aggressive pullbacks, price often dives into the zone with strong momentum, not slowing down. When price approaches a zone aggressively like this, we do not enter, even if we see CHOCH or flip patterns on the lower time frame. The reason is simple. When momentum is too strong, price usually blows through the zone instead of reacting. So during aggressive pullbacks, we avoid entries and only observe price behavior. The corrective pullback is much slower and more controlled compared to the aggressive model. Before applying this or any strategy, remember to backtest at least 100 times. That's a key part of growing as a trader. Corrective pullbacks form with smaller candles, creating internal structures as price gradually moves toward the point of interest. Momentum slows down as price approaches the zone. In our example, the candle breaks the previous low, giving us a valid pullback and a valid BOS, allowing us to identify a reliable order block, demand zone. Unlike aggressive pullbacks, corrective pullbacks give us trading opportunities. When price reaches the zone, we can use either aggressive entry, placing a limit order at the top of the order block, conservative entry, waiting for price to tap the zone, then dropping to a lower time frame to look for CHOCH or reversal structure. Once confirmation appears on the lower time frame, we set the entry at the new demand zone formed by the CHOCH, place stop loss below the zone, and set take profit at the higher time frame external liquidity. The sweeping pullback is based heavily on liquidity behavior. In this model, price forms liquidity pools near your point of interest, equal highs, equal lows, or trendline liquidity. These act as fuel for momentum. Before price reaches your supply or demand zone, a liquidity sweep adds an extra layer of confirmation. If liquidity is not swept beforehand, price often uses the zone itself as liquidity, meaning it may just break through it. In our example, price retraces, forms equal lows, and builds liquidity below them, perfect for a sweep near our demand zone. That liquidity represents stop losses, pending orders, and inefficiency waiting to be collected. Once we have the sweep and the touch of the poi, we can consider entering long. A buy limit can work, but for a more optimized and tighter stop, we zoom into a lower time frame, wait for CHOCH or any structural shift, then take the trade from the lower time frame demand created by that shift. Well, that's it for today, traders. I hope you found this breakdown helpful and that it adds more clarity to your pullback analysis. If you enjoyed the video, make sure you hit subscribe and turn on notifications so you never miss an update from Dion Trades. Your feedback helps shape future videos. So drop a comment and let me know what topic you want covered next. Thanks for watching, and I'll see you in the next video.